Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide valuation and mediation services based in St. Louis, Missouri. Today, we're actually kind of building upon a prior discussion that we had, but we're going to be discussing the pandemic economy and divorce with Josh Shilts and Patrick Kilbane. Josh's practice is really focused on complex financial matters and disputes. He's a frequent lecturer on forensic accounting topics and has been involved with hundreds of forensic investigations dealing with matters involving personal and business disputes, as well as the identification and mitigation of fraudulent activities. He's also provided expert testimony in commercial and family matters surrounding business valuations, economic damages, fraud, and other disciplines having to do with accounting and economics. He's a forensic valuation expert and offers tax advice in the state of Florida. Pat, on the other hand, is a wealth advisor with nearly a decade of experience in helping clients coordinate their wealth management plans. He's also general counsel for Ullman Wealth Partners. He is the director of Divorce Advisory Group, where he assists, guides, and supports clients before, during, and after they begin the divorce process. He helps high net worth clients make financial decisions at all stages of the divorce process by using his family law experience, his wealth management experience, and his certified divorce financial analyst designation. So when you have either, one spouse or both spouses are business owners, and you talked about some capital gains things changing, what does it even matter in a divorce? Like, do we even care about capital gains? And do we care about any changes and things like that? And how is it affecting us?
Well, sure. You always care about it. And when you're analyzing and trying to figure out how you split the assets, look, 90 to 95% of divorce cases are settled. Okay. Yeah. And hopefully the high net worth people are working with forensic CPAs and financial advisors to help make sure that they're comparing apples to apples if do we care about capital gains? Heck yes, we care about capital gains, because you don't want to compare an apple to a giraffe, right? Mm-hmm. And you don't want to stick one party with all of the assets that have an extremely low cost basis, and then when they need to liquidate that for retirement years or whatever, they get stuck with a massive tax bill. So yes, we are always cognizant of capital gains for sure.
Well, and I think that a lot of times, if we're looking at a portfolio of retirement assets and you plan on splitting them directly down the middle, right? Every 2 shares you have of something, 1 share goes to one person, 1 share goes to the other. It's not that big of a deal. But that's not traditionally, I think people traditionally think that when you look at the marital balance sheet, like, we're going to split the house in half, we're going to split the retirement in half, we're going to split the bank accounts in half. And that's not really how it all works out, So in some capacity, we're actually trying to even up the whole pie and split the pie evenly or reasonably, but it doesn't always have an effect. But maybe we should just talk a little bit about that, but taking retirement assets is not the same as taking money in a house or cash or any of those. And Correct. So what do you talk about to people who are getting divorced and who are like, oh, I think I just will take that,
Well, I say that's okay. That's fine. But you just have to realize that if you're taking the house and you're going to keep it, let's say you keep it for 3-4 years, you remain a single person, and there is significant appreciation in the value of the house, and you really haven't done anything to improve it. It's largely passive. Well, when you were married, you used to be able to exclude $500,000 of the capital gain. Now you're only going to be able to exclude $250,000, assuming you don't get remarried. So let's take a look at what your proposed split is. And now let's sort of, take a look at it with a different lens on, taking into consideration, the tax treatment or what needs to be taxed on those assets. So, it tells a different story, but, a lot of people are leery of paying professional fees, and They just think that they can do it, and then they come back and they realize, my gosh, did I make a huge mistake? And in Florida, when you divide the assets, the court does not want to get back in the business of people who have buyer's remorse and fixing the division of assets. So once you do it, it's done.
Mm-hmm.
And, you know, if you value a business and the spouse has worked in the business and somebody says, well, you know, you can have the business, just pay me $50,000. And they say, well, you know, wait a minute, Judge, I should have had a business valuation. Court's going to say, you know, tough. You had your opportunity to have a business valuation and you elected not to do it. Unless there was some duress or something like that, you had a fair shot at a valuation, and we can only assume that you just chose not to do it. Huge mistake.
Yeah, absolutely.